issue with ignoring HECS debt is it's still a debt. Mm-hmm. It still has interest. I hate the fact that they're punishing kids, okay, for it. And I hate the fact that I know personally, firsthand, people under the age of 30 that are trying to make it, okay, that are trying to build wealth and they're trying to create an opportunity for themselves and they're getting punished.
Is this good news for people trying to get on the property ladder, or is it just good news for investors? What's your opinion?
I think that when you're an investor, you're looking for two things: cash flow and capital growth. Go look at apartments in Bondi. 2016, they cost 800 grand. 2025, 850. They didn't grow that much.
Obviously, housing policy, it's a big issue right now. Do you think that this is something that will actually help people get into homes sooner?
So I'm of the personal opinion that...
Welcome to the Finance Show with Joe. He's Joe. I'm just some schmo named Michael. And today we're actually going to be talking about a couple things, more so about first home buyers and younger people and how that helps them in the market. Because Jim Chalmers, our federal treasurer, he has literally told lenders to ignore HECS and HELP debts when doing their debt calculations, which is huge because last year they also did they got rid of that crazy indexation rate that happened when, because it was, what was the indexation was based on inflation, was it? Or CPI or something like that?
It was based on inflation prior to them bringing it down to a different rate.
It's a different rate now. But anyway, that went down. So they're really trying to improve first-home buyers' capacity, really, because I would say that's probably the majority of people who have a HECS debt right now. Am I correct in saying that?
You are correct in saying that. Very interesting that he's come out and said this. And regardless of what he's saying, you shouldn't account for it and you should base the individual's income on their income. That's not how the fucking world works, Jim. I'm sorry to say this, but I would love to be able to ignore HECS debt to be able to help individual borrowers. The issue with ignoring HECS debt is it's still a debt. It still has interest. It's no longer that 0.1% interest that it used to be. I think last year it was 3%. The year before it was like 6. It was something stupid.
Right.
So to say, oh no, we're going to ignore this debt completely, it's not going to happen. It's an empty promise. The treasurer has come out to say this to win favor amongst young people. However, I will add that the lenders calculated incorrectly. So I almost got fired at Macquarie for this. I'm just going to highlight this argument that I had 8 years ago.
Okay.
It was myself, 20 people from credit, everyone in the direct team and everyone in the private team. And I put my hand up and I said, why are we not including HECS in monthly expenses? And it started a riot. It started a 2-hour argument of why we should not be included HECS debt in living expenses.
Okay.
Because this is not something that the individuals at uni have control over. At the time, it was not something that had a high interest rate. You know, we saw a couple of years ago people paying like 6% or whatever it was on their HECS debt. Back then, back in 2018, it was 0.1%. So it was a bit of monthly expenditure that it wasn't a debt to a car. It wasn't a personal loan for, it was something to help them in their education.
Yeah, and the careers, hopefully.
100%. I had the head of credit say to me, I'm going to check every single one of your files moving forward. I'm like, why? I want to understand why we cannot include this in the weekly expenses. The problem also with a lot of lenders is, for some reason, I don't know if they've all updated it, but some of them have included a buffer on HECS debt.
And that was another one of the things he was like, get rid of that buffer.
Yeah. So regardless of whatever the interest rate was, they were adding 2 or 3% on top of that of whatever your HECS repayments are. They're saying, nah, it's 3% more. So instead of them paying what was it, 3.99%?
Sure.
Something last year. No, you're not paying 3.99% on your $70,000 HECS debt. You're paying 7%. People were unable to afford property because of that buffer rate. So I'm of the personal opinion that HECS, it does need to be included because somebody that's paying HECS and someone that's not paying HECS, if you're making $90,000 a year and you are paying HECS, your take-home salary is $2,500 a fortnight.
That's correct.
If you are not paying HECS, it's $2,700 a fortnight.
Yeah, so it's about $200.
Yeah, so it's $200 difference. $200 difference, multiply that by 26 fortnights, $5,200 a year.
Yeah.
Okay? To say, oh, no, don't include the HECS debt. No. You have to include the HECS debt. If somebody has an extra $5,200 a year to spend,
Increases their borrowing capacity.
that is an increase of about, I don't know, 100 grand or so. If they get rid of their HECS debt, I can't remember the exact figures, but it's something stupid.
Yeah.
To just say to ignore it is incorrect. But I think that you need to include it in the monthly living expenses because it's not supposed to be a rate that spikes up, goes down. And if you see on a payslip, the amount that you pay back to HECS is not dependent on what the interest that they charge is. It's dependent on your salary.
Yeah.
So if you've got a $40,000 HECS debt, okay, for example, and you're making $90K a year, you're paying $200 a week, fortnight, sorry.
Fortnight, yeah.
If you've got an $80,000 HECS debt and you're earning $90,000 a year, you're paying $200 a fortnight.
Yeah, and obviously,
And it goes over and over. $250,000 HECS debt, you are still paying $200 a fortnight.
Yeah.
So the way that they're calculating it is incorrect. The way the banks assessed it is completely incorrect. I'm on Jim Chalmers' side for one small portion of it. The banks are calculating it incorrectly, but I'm going to add that this is how they should calculate it. Don't calculate it based on what their interest rate is or what the month. Don't calculate it based on that. Don't include a buffer on HECS. You're already punishing the youth enough. People that are 30 and under are already struggling to be able to purchase a property, and then you're going to turn around and say to them, "Oh no! Guess what? Oldie McOld over there who purchased his property in 1980 and paid off his $1,000 HECS balance 5 years after uni,
or he got it for free,
He's completely fine.
Yeah.
Okay. But the person that's just got to uni, done it tough for 4 years, relocated, everything. No. We're going to punish them for it.
Yeah.
And guess what? Oldie McOld is going to look at the apartment that, the young kid wants to buy and say, oh, that's a good investment.
I was going to say, yeah.
Yeah, that's going to make me $600 a week. I love that. And then the other kid is going to go, but I wanted that house.
I wanted to live there.
I wanted to get out of there. I don't want to be paying someone rent. So
this is where we're rent investing, but then you don't have the money. And
yeah, there's so many things. Yeah. So I'm going to be a bit rage baity right now.
Yeah, no.
And I'm just going to highlight it. You can't ignore it, but you also have to factor it in. You have to factor in how much HECS do they pay based on
their income.
Based on their income level.
Yeah.
It's fucking dumb.
That makes sense as well because, well, like you said, it's a huge difference because it's interest in a sense, but it's not pay. Like again, you don't pay more if you don't earn more. So yeah, okay.
I'm going to give you the best fucking example. Listen to how passionate I am right now because I'm so agitated.
I didn't know this HECS thing would get him going like this.
I fucking hate it. I hate HECS. I think the way that the lenders assess it is stupid. I think the way that the government assesses it is stupid. I hate the fact that they're punishing kids, for it. And I hate the fact that I know personally, firsthand, people under the age of 30 that are trying to make it, that are trying to build wealth and they're trying to create an opportunity for themselves and they're getting punished.
Yeah, and it especially sucks too because they were told that going to uni was a way to do it, like to earn heaps of money and get ahead in life.
My kid's becoming a plumber. No doubt. No doubt. Year 10, bang, plumber. My degree's in economics and maths. Do you know what you could do with that? It's the most generic degree ever. I'm a mortgage broker now. It is so freaking generic.
Oh, goodness gracious.
So why did I go to uni and pay a $30,000 HECS debt?
Yeah.
For what? For something. I'm now.
Business. You're a small business owner. You didn't need to go to uni for that.
I didn't need to go to uni for it. I didn't. Do you know how long it takes to become a mortgage broker? A qualified mortgage broker?
A couple months.
I wish.
I'm just joking.
It's a 2-day course.
I said a couple months.
It's a 2-day course to become a qualified mortgage broker.
Damn.
And all of these companies, I'm rambling, Liam, I'm sorry, put it on the edit room floor. It is a 2-day course to be able to handle somebody's life savings. It's a 2-day course to be able to create a mortgage for someone. It is a 2-day course to be able to earn that high of a commission. All of it. I didn't need my degree in economics and maths. It's good that I have it.
Yeah.
Because I can look at things and problem solve them quite quickly.
Your brain is now wired to think a different way, which is beneficial, yeah.
But to become a mortgage broker, it's a 2-day course. And I can guarantee you, the top 30% mortgage brokers, I'm not talking the top 5%, the top 30% mortgage brokers are earning a lot more than 100% of the economists out there.
Okay.
Guaranteed. Anyways, back to what I was saying. Fuck, what was I saying?
I don't even know anymore, but I'm taken aback.
Yeah. So this is back to my example. I had a client last year. Okay. Love this client. Known them for 15 years.
Yep.
Okay. I see them every day at the gym, 4 a.m. Okay. They're working out. They approach me and they go, hey, I want to purchase another investment property. Fantastic. Had a look at their job, earning good money. They've got their HECS debt left over. Fantastic. And they've got their property. They've got a red brick apartment over in Janali. Okay. Property's grown in value. They want to refinance. They want to purchase another investment. With the HECS debt, $40,000 HECS debt, the maximum that they could borrow was $399,000.
Which isn't getting you anything.
Not only that, their mortgage was more than that because of the increase in interest rates.
Oh, yep.
Okay. Without the HECS debt, they could borrow $500,000.
Which might get you an apartment somewhere.
Make that make sense. You've got $40,000 in HECS debt. So their overall debt level was $440,000. But if we got rid of the HECS debt, they could borrow $500,000. Yeah. So there's a $60,000 increase.
Yeah.
Their HECS balance didn't go down because of these stupid interest rates. Because if they were making repayments based off what the interest rate was and the principal and everything, okay, they could eventually pay that HECS debt off. But all they're doing is just paying interest because they've changed the way that HECS debt is assessed by the government. Yeah. And because of the wage levels. So instead of us saying, hey, can you stay put and wait until the interest rates come down? We created the opportunity for them. We said to the lender, hey, we're actually going to refinance them and we're going to pay out their HECS debt. Here is the BPay slip for you to go and pay out the HECS debt, $40,000 balance. Then all of a sudden, they've got $60,000 in equity. Yeah. They could purchase an investment property.
They're making money.
Stamp duty. And guess what? Their take-home income was even higher as well. They increased their cash flow. Yeah. They increased their cash flow by getting rid of that HECS debt. I think that we increased the cash flow by like $3,000 as well. So they were $63,000 better off. It's amazing. Okay. So when I get people say to me, should I pay my HECS balance off? Is it going to give me a better borrowing solution? Yes. Yeah. If you have the means to pay off your HECS, pay it off. Yeah, okay. Okay, because it's going to open up a world of opportunity for you.
Even if all it does is improve cash flow, worth it.
Improves cash flow. It improves your borrowing capabilities. It improves your opportunity. There's $200 a fortnight. Okay, it doesn't sound like a lot, like in the great scheme of things.
But it's the little things.
But $200 a fortnight is $5,200 a year. $5,200 a year. That's a holiday to New Zealand. Maybe you need a mental break. Camera equipment, upskilling yourself, starting your own business, creating a side hustle. $5,200 a year could definitely go towards that.
Yeah, invest in yourself.
Investing in yourself.
Yeah.
So, roundabout, long way to give you an answer. Pay off the HECS. Yeah. Okay. And an answer to the banks as well. Hey, guess what? Change the way that you assess it. It's not based on interest. Yeah. It is based on
It's not
income.
a normal loan. Yeah.
It's not.
It's not a normal loan.
It is not a normal loan.
Which has benefits and drawbacks, as we've just explained. Yeah. Now, speaking of benefits and drawbacks and where to put your money.
That's an amazing segue. So, after my 20-minute rant.
There are 25,000 homes set to be built in New South Wales. And it's not literally the houses being built. It's a lot of infrastructure stuff, which isn't sexy.
Yes, it is.
But it is essential. Now, and this is just New South Wales. This is part of the overall federal government's housing support program. You remember that 1.2 million homes thing? Yeah. This is part of that.
Nice.
There's $182 million being invested in New South Wales in these suburbs. So Kempsey, $45 million. Goulburn, $27 million. Griffith, $10 million. Cessnock, $22 million. Maruya, $4 million. Parramatta, $10 million. Schofields, $13 million. And Dulwich Hill, $6.2 million. And that's all for infrastructure, basically. New roads, water treatment, stormwater stuff, those kinds of things. Not sexy, but it does unlock potential for new homes.
That's amazing.
Is this good news for people trying to get on the property ladder, or is it just good news for investors? What's your opinion?
It's good news for both. And the reason I want to highlight it's good news for both is the suburbs that are being taken on. Number one is Goulburn.
Mm-hmm.
Canberra has become too expensive to live in.
Too many roundabouts. Got to pay to upkeep them.
But Canberra's it was a hotspot.
Yeah.
Property grew
Solid
in
amount.
line with Victoria and New South Wales.
Yeah.
Over the booms. I think the median house price got to like 1.2 million, 1.3 million. So a lot of people in ACT found it too expensive.
Yeah.
40 minutes up the road on highway. Highway driving is different to city driving. 45 minutes up the road on a highway, you have Goulburn. You're buying for a third of that price.
Yeah, and you get the big ram.
So you get that too. Cut that out. But yeah. Goulburn, for example. I've seen a lot of my own clients purchasing in Goulburn.
Okay.
Property's going up in value there. It's a great spot. This investment is probably going to unlock more land down there.
Yeah.
You have a lot of government workers actually finding it easier to drive from certain parts of Goulburn into Canberra than from purchasing somewhere on one of the outer suburbs of Canberra and then driving in.
Yeah, okay.
So Goulburn, I think, is going to benefit quite a lot on both the owner-occupied and the investor side.
Okay. Well, I mean, the government estimates say this is going to be about 430 new homes.
That's fantastic.
Yeah.
A lot of Goulburn is old. A lot of it is heritage. By providing that infrastructure, it's going to open up the market for a lot of people.
Yeah.
I think owner-occupied people are going to benefit the most in Goulburn.
100%, because it's not really an investment hotspot. Although if it becomes more general knowledge, if you're living in or working in Canberra, that it's cheaper to live in Goulburn than Canberra itself, maybe we might see that change.
Parramatta, massive winner. Massive winner. Parramatta's the second CBD. Have you gone to the new Parramatta Square?
No, I've just been on the train in the station, so I kind of, whatever I can see out the window.
It looks like Sydney CBD.
Oh, yeah, it definitely does. If I'm not paying attention, I think I'm in Central sometimes.
Yeah, it is phenomenal. If they want to invest in it, make it the second city, make it the second part of Sydney. They've done a great job.
Well, they've got that light rail now as well. Yeah.
So previously, Parramatta had an issue with oversupply of apartments.
Yeah.
What this infrastructure project is going to do is it's going to open up a lot of travel between Parramatta CBD and Sydney CBD and potentially other suburbs.
Yeah.
And it will allow Parramatta to become more of a hub, and it will provide ease of access for people who need to work in that area.
And Parramatta's a pretty convenient location.
It's fantastic.
Yeah. So this will enable estimated to enable 15,000 homes.
It's fucking sick. Schofields, same as the other stuff I was talking about before.
Yeah.
You know, an 86-meter bridge.
Yeah, I'm guessing it goes over the Hawkesbury or something like that. Because I live near Schofields and I'm not really sure where that bridge is supposed to go. But that 13 million is supposed to enable 235 new homes.
Dulwich Hill, 7,800 new homes. That's huge. So Dulwich Hill, next to Marrickville, Enmore, I feel like it's all in that area.
Yeah,
Inner West.
in and around the Inner West, yeah.
The Inner West is all heritage.
Yeah, which is, I think, so what they're doing, they actually, as opposed to the other ones, they're actually doing a transport tunnel under Old Canterbury Road.
Yeah.
And that is then supposed to link each side of the road in different suburbs where they can, I'm guessing the heritage isn't that prevalent, or maybe they've already knocked down, or maybe they're just changing the zoning. I'm not really sure.
Hopefully.
I don't really know how the 7,800 new homes thing will fit. But
It'll be apartments.
It's surely, right?
It's gonna be 20 lots of apartments. Each block is gonna have God knows how many. But that's actually better for owner occupiers than investors. Now
it's a decent spot to live in.
we spoke about it countless times on the show.
Yeah.
If you want to buy and make money, go for something that's got land. If you want to buy somewhere that you want to live, go and buy an apartment.
Yeah.
Okay, because apartments, low upkeep. You don't have to go mow the grass. You got to pay strata. Nobody likes paying strata, but that is the cost that you pay for that sort of convenience. My opinion is the biggest benefit for Dulwich Hill is actually going to be people that are looking to purchase owner-occupied properties as opposed to potential investors. When you're an investor, you're looking for two things: cash flow and capital growth.
Yeah.
How did I forget that? But you're looking for those two things. Go look at apartments in Mumbai. 2016, they cost 800 grand. 2025, 850. They didn't grow that much.
Okay.
Go look at apartments in Parramatta. 10 years ago, 700K. 10 years later, 770. Something along.
Yeah. So it's you're not seeing. I mean, the apartments in Australia never see that explosive growth that like houses, standing houses do.
But apartments are great for depreciation and they're great for cash flow.
Yeah.
Or
if you just want like rent, if you can get that thing positively geared.
Yeah.
Yeah.
Or they're great to live in.
Yeah.
And
I think I'm an apartment dude.
Yeah. So, you see?
Yeah.
You like apartments. You like the ease of living. You don't want to be jumping outside.
I don't want to drive. I don't want to drive.
That is exactly what I wanted to hear.
Yeah.
So Dulwich Hill, that 7,800 new homes project, that is made for you. You don't want to drive too far. You want to have the ease of access to the city, to other locations, okay? And you want a low maintenance lifestyle.
Yeah, essentially. I hate mowing grass.
Yeah. So Dulwich Hill is going to be made for those young Australians. Yeah. Now, will it grow in value because of its proximity to the city? Yes.
Yeah.
Okay. But is it going to explode in value like a house, land, duplexes, those sorts of things? No. So I think the owner-occupiers, the youth, you and your fiance, you want somewhere to live close to the city, this is going to be a great option for you.
Yeah.
That sort of area.
Yeah.
You know, our videographer, Liam, this is going to be an option for him if he wants to live close to Sydney CBD.
Yeah.
My wife and I, if we were 10 years younger, we would probably be looking at Dulwich Hill. We would be looking at that area because it's central, it's close to family, you know, there's Daewoods everywhere. Like, we'd be fine. It's an important thing. It's an important thing. So rather than thinking of it as an investment, it's going to definitely be an owner-occupier area. Okay. And I think that is the best way to look at that. So you have to look at the suburbs. Is it going to be good for the owner-occupiers or the investors? Dulwich Hill, it's all going to be vertical moving. It's going to be great for the owner-occupiers. Yeah. Schofields, it's going to be great for the investors because that's unlocking a whole new area, different land, and that's going to create connection, ease of access. That's going to be great for somebody that's looking to invest and make money in capital growth. Yeah.
That makes sense. That makes a lot of sense.
Yeah.
So, by the way, this advice is all general in nature. All right, well.
Did I give it? Yeah, okay, yeah.
Regardless, it's there now. All right, well, that's great. That is good news. So this, not to get too political, but it's like obviously housing policy, it's a big issue right now. Do you think that this is something that will actually help people get into homes sooner rather than later? Yeah, like actually effective policy.
The only thing I'm worried about is we're banning foreign investment for 2 years.
Oh, the foreign investor ban,
on existing properties.
Well, they're just going to buy this up,
That's the only thing I'm worried about. However, we have seen a lot of Chinese investors. They've exited Australia, not completely. But,
no, just lesser rate,
But they're looking at markets like Dubai, Saudi Arabia, Qatar. You know, where foreign investment tax is a lot lower and, you know,
populations are smaller and they're not really crying about housing crises and stuff.
But you're also seeing a lot more capital growth.
Yeah.
People are moving to those countries in droves, like especially digital nomads. They are picking up, they're going to Dubai, they don't have to pay tax. They can set up a visa, the golden visa, and live there for 10 years and essentially have a thriving company and connect with a lot of people who are looking for similar opportunities.
Yeah, look, it makes sense.
And the funny thing about Dubai is there's no dole bludgers. You work there.
Yeah.
You have to make money or they literally kick you out of the country. Oh, you live here and you're not working? Out. Police will come and knock on your door and kick you out of the country.
Oh my God.
It's a very strange place.
Oh, well, bloody hell. I've only been to the airport. That is all I can say about it.
To wrap that up,
Yeah.
I'm hoping because they're new properties, we won't see too much of a foreign investment boom. You will see a little bit because their market is limited. But depending on the area, speak to, I want to say a buyer's agent. Don't speak to a real estate agent. They'll sell you anything.
Yeah, go to a buyer's agent.
Speak to a good buyer's agent. They'll put you in a good position and go from there.
Okay.
Perfect.
Well, that sounds great. Well, going from there, let's do our favorite segment of the show, the client profile. I won't throw you a curveball this time. This is a far more reasonable one. All right, so we got Debbie, and she saved a 20% deposit and has approached you to get help for a loan for a property that she's already got her eye on. So while in the process of getting pre-approval from a lender, Debbie finds out that the property that she wanted has actually already sold, and she's now spent a solid amount of her deposit on luxury items like Gucci handbags. I actually overheard this. Joey once did this. Now, she still wants to buy a property, but with a reduced deposit, but she doesn't actually want to go for a cheaper property. She wants to keep it at the same level. How would you guide Debbie?
I'm honest with my clients and I'm transparent. I'm going to tell her that she's just fucked herself.
Yeah, you ruined it.
Like she's actually, I'm not going to say it in those words, but she's essentially gone and ruined quite a few things because number one, now we can't see if she's a responsible spender.
Yeah, and banks are going to see that.
Banks are going to see that. When we are reviewing the bank statements, we are going to see an exorbitant amount spent at Gucci.
Yeah.
Then we have to question the deposit because it's a 20% deposit and that has now reduced.
Yeah.
Let's say it's a 5% or a 10% deposit. Banks are going to want to know genuine savings. Now, because it's no longer a 20% deposit and that has decreased, her interest rate's going to go up because banks lend based on the tier.
Yeah, okay.
The less of a deposit you have, the higher risk you are, the higher interest rate that you have to pay.
Yeah. Standard practice.
Then on top of that, the lender's mortgage insurance.
Yeah, which you have to pay if you don't have a 20% deposit.
Depending on the lender.
Yeah.
So now we've got to get that involved. There are so many issues with what Debbie has done. And I'm going to tell her, can you get a refund?
Yeah, can send it back.
Because there's a chance the banks are going to look at this and they're going to think that you are an irresponsible spender and you don't know how to control your money. You're going to be late on repayments. You're going to default. We're going to kick you out of your house.
Damn, yeah.
The banks are there to make money, not kick you out of your house. They don't want to end up on a current affair.
Yeah, this is true.
The second thing is we have to be realistic. We are going to review the living expenses for the 6 months prior. And we're going to see, is this a monthly thing? Was she just given $200,000 to go buy a property?
Yeah.
And then she lost the property, spent $50,000 on Gucci bags? We're going to look into that as well.
Yeah.
And then we are also going to decide whether or not we want a borrower like this. Because if we have to spend this much time telling someone, don't be an idiot.
Yeah, stop spending the money.
Stop spending money like this, then it's going to be a waste of our time.
Yeah.
Okay, there's 56,000 brokers in Australia. Okay? If you're coming to me with this issue and you can't control your spending, and then the next time we speak to each other and you tell me you've gone and you've spent this money again, I'm going to tell you, I'm sorry, I can't help you.
Yeah.
My advice, steps for the advice. Try and get a refund. You can't get a refund, okay, put those bags aside, try and resell them, or keep them. You're never allowed to shop at Gucci again. Give them your photo, tell them to ban you.
Yep.
Okay? Step number 2, be realistic. Okay, you've reduced your deposit now. Now we have to increase your interest rate. Now we have to increase, there's a potential that you have to pay lender's mortgage insurance. There's a whole bunch of other things. So guess what? Your borrowing power is going to go down. Instead of you being able to buy $1 million property, it might be an $850,000 property.
Okay.
Things that are involved with that. Okay? Then, once she finds a property, do not delay it. Okay? If we have you pre-approved, conditionally approved, whatever we have, an unconditional pre-approval, whatever you want to call it, if we fully assess pre-approval, if we have that, make the offer and try and go for the property. Now, you do always have to think about a property, get your 10-day cooling off period, make sure you have a good conveyancer solicitor, but don't go and spend that money. And if you are going to buy that property, make sure you take into account what you're actually doing.
Yeah.
You are going to be fiscally responsible for the next 30 years to make those repayments to purchase a house.
Yeah.
Don't go blow that money on that sort of stuff.
Yeah.
Blow that money on that sort of stuff
Later.
later. I'm not against people having nice things. I like nice things. You see what I wear. Okay? But I am against doing it irresponsibly.
Yeah.
Okay?
When they technically have the money, like the figure is in their account, but they don't really have the money.
They don't realize. I know 100 people that could go and buy a Lamborghini.
Yeah.
Okay? I know 99 people that can't afford the upkeep of a Lamborghini. To service a Lamborghini is $20,000, $30,000.
Yeah, the insurance as well.
Insurance is high. You can't drive it everywhere. It's impractical.
You're not going to pick up your kids from school.
It's a two-seater. You have to buy another car. Okay,
the trailer.
Where are you going to store it? Like, there's just so many things that are involved. So you just really have to highlight what is important, what's not important to you. And I would sit down and have that conversation.
Yeah, what are your actual financial goals? What do you want to achieve?
Timeline it. It's great that you bring this example up because another case study last year. I had a client. Oh man, this was a hard loan. Complete financial distress. Got scammed, superannuation stolen.
Oy.
Was in an accident, was on workers' compensation.
Oy.
Okay? And also told the lender, their bank, even though they could afford their repayments, hey, can you pause my repayments for a second?
Which is already like raising red flags at the lender's side.
So when you pause repayments, you go on worst repayment history status. So you get an RHI for a year. Oh, no. You get the financial hardship one, the FHI.
Okay.
So if you've got an FHI on your bank status, that means that you have to wait 12 months for that to be cleared before you can go to a major lender. So our options are already limited because her only source of income is workers' compensation. There's like 4 banks that take that.
Oh, gosh.
All right, 4 banks that take that. Now, all of a sudden, that has reduced to 3. That has reduced to 1 because she's also got the financial hardship. Okay? So they approach me. They say, I want to refinance my mortgage, pay out all these personal debts, and I want to buy a Mercedes AMG.
Why? When you were already drowning.
So they got scammed, divorce, all that sort of stuff.
Yeah.
But I said to them on the phone, and I'll never forget this conversation. I go, you go and buy that car. I am not approving this. I am not sending your loan to this lender.
Yeah.
I am the only person that has helped you after you've gone to 18 other people to try and help you.
Yeah.
Okay? If you want the money to clear out your personal debts, if you want the money to be able to build yourself back up, sure. But if you're going to take that money and put it in a Mercedes AMG, something that I now know for a fact that you don't have the money to insure, that you don't have the money to put petrol in, okay?
Yeah.
If you are going to do that, I am not going to approve this loan for you.
Imagine.
I don't even have the right to approve or not approve a loan, but I wasn't going to submit it.
Yeah, you weren't going to help them. Yeah. Imagine you're falling off a boat, no fault of your own. Choppy sea. You're falling in, you're drowning, and you go, chuck me a bag of bricks.
Yeah. The bag of bricks will help.
Yeah.
Like, it's just when I heard them say, yes, I want to buy a Mercedes AMG after everything else this person had been through.
You're definitely not making money ever.
You're not going to make money on it. You're going to lose money. And you are putting yourself under more financial duress. And I know my cars. That particular car has issues. So, like...
It wasn't even a good car.
No. It was one of the lower end AMGs. It was the A45, I think it's called.
I can never remember the numbers that are attached to it.
But they got issues with turbos and stuff. Like, she's going to buy something that's a lemon, And they wanted to spend $70,000 on it. So...
Buy a Toyota.
That's exactly what I said.
Buy a Toyota.
I said there's 100 Toyotas online that have the same features. You've got Apple CarPlay, you've got all these things. And then they turned to me and said, but I've got divorce hearings and I want to be able to show them that I'm strong. And I go, you show them that you are strong?
Not by showing up in an AMG.
Not by showing up in an AMG, but by showing up that you are strong and that you could pay your legal fees. We submitted it, got it all approved. 12 months later, they have come back. They've made all their repayments.
Oh,
okay? They managed everything. They cleared out all the personal debts that they had owing. And now they've approached me for a car.
When things are done.
And they're no longer on workers' compensation. They've got a job full-time. Guess what? Okay, you want to buy yourself a car now? Let's get you a car. But not when you are under that much duress. And that's how you win.
At least the story has a happy ending.
Yes, it actually does. We actually got them formally approved a few days ago.
Oh, there you go.
No, this is a true story. I can't name names, but
No, yeah.
imagine how hard I was clicking it when all that stuff was going down.
Oh my god,
Yeah.
you've been tweaking, man.
But yeah, as always, guys, borrow responsibly. Don't drink and borrow. No, sorry.
When you borrow, don't drive.
Yeah. As always, guys, if you want somebody to help you borrow responsibly,
Yeah.
what a segue. You can visit us at www.itsimple.com.au. Whether you, your friend, family, you need help with your home loans, refinancing your loans, or purchasing your first home, we're there. If you want to find it, we're there. I'm tired. You can find us on LinkedIn. You can find us on Instagram.
Yeah.
I'm always available. And as always, my name is Joe.
I'm Michael.
You're no longer a schmo.
I still am a bit of a schmo.
You're getting there. We'll see you in the next episode.